So for this mock exercise, we're going to take a look at a company called Yount Corporation. We're going to actually go through recording the property, plant, and equipment transactions. We're going to actually do some journal entries, and we're going to attempt to prepare a balance sheet, a partial balance sheet on the capital asset section. So let's take a look at the question. So this question starts with on January 1st, 2009, the beginning of the year, the company reported the following property, plant, and equipment account. So they're giving you the building, the equipment, and the land, and they also gave you an accumulative depreciation balances for both the equipment and the building. Now, they gave us some information, and the first one they said is they use a straight line depreciation for building and equipment. And they also told us that the fiscal year is December 31st. Now, we're also told that the building had an estimated useful life of 50 years and no residual value. And the equipment is estimated to have 10 years useful life with no residual value. Interest in all notes is payable and collectible at maturity on the anniversary date of the issue. So we're given some information, and we're told also that during 2009, these were all the transactions that related to the property, plant, and equipment of this company. So for Part A, it's asking us to record the transaction, and Part B says what are the adjusting entry at December 31st, and then Part C says what would the property, plant, and equipment section of the balance sheet look like on December 31st. So let's start with the first journal entry. So it says on April 1st, they purchased land for $1.9 million. They paid $475 and issued a 10-year 6% note balance, note payable for the balance. So let's do that journal entry. So on April 1st, we're going to record the purchase of the land. So debit land, $1,900,000. We're going to credit cash for $475, and we're going to credit notes payable for $1,425,000. And that's the remaining balance to balance out to the $1.9 million. The next is on May 1st, they sold equipment for $350,000. Okay, and the equipment had a cost of $750 when it was originally purchased in January 1st, 2005. So here's the key thing about on May 1st. We know that the equipment was sold on that date, which means that we need to record the amortization expense of that equipment prior to the date of sale on May 1st. So the first thing I need to do on May 1st is to record the depreciation expense. So, so we need to record depreciation expense, for January to April. And how many months is that? That would be 4 months, right? So how did we determine that? Well, we know the original cost is $750. There was no residual value, and we're told that the equipment has a 10-year life. So we know that that is $75,000, and multiply by 4/12 to give us $25,000. So we're going to debit depreciation expense, credit accumulated depreciation. Now, we need to determine the net book value as a second step. Of asset disposed. How do we do that? Well, first of all, we have a cost, right? and that was for $750. What is the accumulated depreciation? Okay, so we know that the accumulative depreciation for the equipment, how many years? So we bought this on January 1st, 2005. So we've got January 1st, 2005, so 5, 6, 7, 8. So that's 4 years up to December 31st, 2008, plus the May. So we need to determine the accumulative amortization times 4 years, right? Plus, we need to add a $25,000, which reflects the May 1st. So the net book, so the cumulative depreciation is $325, right? So we bought it in 2000, and the question says we bought it on January 1st, 2005. So 2005 is 1 year, 2006 is second year, 2007 is the third year, and 2008 is the fourth year. So there's 4 years. Because this was on May 1st, 2009, we've already recorded $25,000. That's the accumulative amortization. So the net book value is $425. Now we're going to subtract from that the proceeds of disposition. Proceeds of disposition. What did we get for it? We got $350. So because we got less than the net book value, we have a loss on sale. And that's $75,000. So what is our journal entry? Our journal entry is going to be debit cash for $350. We're going to debit accumulated depreciation, $325. We're going to credit machine, or in this case it would be equipment, right? For the original cost of $750. And we're going to debit the lost on sale. So that would be our journal entry. So the takeaway on the May 1st was when we sell an equipment, we need to update the depreciation expense because if you think about it, we did use the asset from January to April. So we need to update the depreciation expense first. That's what we did here with the $25,000. And then we would have to calculate the gain on sale of the asset. By doing that, we need to determine the net book value. And the question didn't give us, because this is part of a bigger asset, right? That $750. We need to figure out what was the cumulative depreciation on that asset, and that's exactly what I did here. Is we took the $75,000 divided by 10, okay, and sorry, it's not 75, it's 750,000. I apologize. There's an extra zero there. Missing, and then divide it by 10 years times 4, and then you're going to add the depreciation from January to April 30th to come out to the cumulative depreciation for that particular asset. And you've got a net book value of $425. Compare that to the proceeds of this position to give us a loss of $75,000. Now, on June 1st, so that would be the entry for May 1st. On June 1st, we sold land for $1.2 million. We received $380 and accepted a 6% note on the balance. The land cost $300 when it was purchased in 1993. So the April 1st entry is actually not that bad because there's no depreciation on land. So all we need to do is show the disposal. Right, show the disposal of the land. Okay, so first we're going to credit land, and the cost of that land was $300,000. We're going to debit cash because we got cash, and we're told that we received $380,000. We also receive a note receivable for $820,000. So altogether, we got $1.2 million. So this is $1.2 million. And it costs us $300,000, so we have a gain. So gain on sale of land would be $900,000. And by the way, the gain on sale of land and the loss on sale of equipment is shown where? It's shown under other income and expense in a multi-step income statement of this company's statement of earnings. Okay? Now, on July 1st, they purchased equipment for $1 million on account. Okay, on account means it's in accounts payable. Okay, so let's do that entry. Oh, it's July 1st, sorry. So debit equipment, $1 million. Credit accounts payable, $1 million. And then it says on August 30th, we pay the amount owing on the purchase of the equipment. So on August 30th, we're going to debit accounts payable, $1 million. Credit cash, $1 million. And then on December 31st, it says retired equipment that cost $470 when purchased on December 31st, 1999. Okay, so we retired. That means that we finally used up the equipment, and now we're basically disposing of it for $0. That's what it means. So on December 31st, first of all, we need to amortize that equipment, right? Because we used up for the entire year. So debit depreciation expense, credit accumulated depreciation, equipment, and it was $470. Again, every equipment is 10 years. And we used that for the entire year, so that's $47,000 per year. Now, we also know that this equipment, when we bought it in 1999, 10 years later would have been December 31st, 2009. So this equipment would have been fully depreciated. So the second entry is we're going to debit accumulated depreciation for 10 years, which is $470, which is really the cost, isn't it? Credit the equipment for $470. So when it says they retired the equipment, it means that we've finally got rid of, or we've disposed of, a fully depreciated equipment. And you can see that there's no gain or loss in this entry. Now, if this equipment has been fully depreciated and they were not retired, in other words, we're still using it, then it would just stay on the books as the equipment $470,000, and you would have an accumulative depreciation of $470 with net book value of 0. Now, the part B says, what are the journal entries for December 31st? So that's the second part of the question. What are the journal entries on December 31st? So what are the adjusting entry on December 31st? So the first one is we need to depreciate the building, right? So the part 1 says building depreciation. Now, we're told in the question the building is the cost is $228,500,000. We're told there was no residual value, and the useful life it says is 50 years. But our standard says 50 years is too long, and in fact our standard says we should amortize the asset no more than 40 years. So that's why this is not 50, it's actually 40. And that should give us $712,500. Now, during the year, there were no dispositions or acquisition of building, so that would be the full amount of depreciation. So we need to debit depreciation expense. $712,500. Credit accumulated depreciation building. Okay, next, we're going to deal with the equipment. The equipment depreciation, okay. So remember, we started the equipment with $48 million. That was the balance on January 1st, 2009. Now, we sold on May 1st, right? So on May 1st, 2009, we sold $750,000 worth of equipment. And I've already taken the amortization into account already. And then we also retired an equipment on December 31st. And how much was that? That was $470,000. So the balance remaining on the equipment is $46,780,000. And we know that this is over 10 years. So the amortization is $4,678,000. Now, on July 1st, we purchased $1 million worth of equipment. And again, that was for 10 years. In this case, it's $100,000. But because we bought it on July 1st, we're going to prorate that, which gives us $50,000. The reason why I didn't add the $1 million up here was because these assets, right, should have been depreciated for the entire year. But this one was only bought on July 1st, so I have to prorate it for 6 months. So the sum of these two is $4,728,000. That would be the total depreciation for the equipment. So the entry is debit equipment. Debit depreciation expense, 4728, and we're going to credit accumulated depreciation equipment. Okay, now land we don't have to depreciate. So now we've done all the depreciation, and what's left are the interest, right? The interest. So the first one is the interest payable. Remember, we bought on April 1st. We purchased. Actually, it wasn't on April 1st. It was June 1st. We purchased land, didn't we, on June 1st? Okay. And that was for $1,425,000. So So the 1,425,000 was the balance owing, right? Was the balance owing for the April 1st purchase of the land, right? So this is the April 1st. 1425, and that one was 6%. And because it was April 1st, it was 9 over 12 months. So the total interest is $64,125. So the entry is debit interest expense, $64,125, credit, interest payable. And then the other one, this is on December 31st. The other one was a receivable. Okay, and the receivable was to do with the fact that we, on June 1st, right, we had a receivable of $820, a note receivable, outstanding on June 1st. So we're going to take the $820, and it was at 6%, but this time, because it's June 1st, it's 7 over 12. Because remember, these are annual rates. So $28,700. So we're going to debit interest receivable, and credit interest income. Now, under the multi-step income statement, interest income and interest expense are captured under the other section, other income and expenses in the multi-step income statement, along with gain on sale of capital assets. So all of that will be captured under the other income and expenses. Now, Part C says, what does the balance sheet looks like? So the balance sheet, of course, we have to do a partial balance sheet as at December 31st, 2009. We'll have under property, plant, and equipment, would have land, and the land value would have been the $4 million plus the land that was purchased on April 1st of $1.9 million. So that would be that would be the land would be $4 million plus the $1.9 million. That would be $5.9 million. And then we sold $300,000 on June, so that land would be $5.6 million. So let me write that down. It would be $4 million plus $1.9 million minus $300,000. That would be the $5.6 million. Building. The cost of the building would be the $28,500, right? That would be the original cost, because we didn't really adjust for that, didn't we? We didn't really bought or purchased or sold buildings, so that's $2.8 million. And we're going to have less accumulated depreciation. And that accumulated depreciation for the building would have been the $12,100,000 plus the depreciation expense of $712,500. And that would be the accumulative depreciation of $12,812,500, and that will give us a net book value of $15,687,500. Now we've got equipment. Equipment had multiple activities. We had 48 million. We added 1 million in July 1st when we bought, right, that equipment on account. And then we're going to subtract 750,000 because we sold that equipment on May 1st. And we also retired an equipment, didn't we? So that means that the overall cost of the equipment is 47,780. We're going to subtract the cumulative depreciation. And that cumulative depreciation would be the 12,100,000 that was sitting on the beginning of the year. Actually, no, it wasn't. It was 15 million. Then we had adjustments to it. Okay, so we needed to add the 25,000 plus the 47,000. So the 25 was on May 1st. We had to update that before we sold that equipment. We also had to depreciate, to record the depreciation on December 31st for the retired asset. And we also needed to record the depreciation expense on December 31st, so 4.728 million. Then we're going to subtract the disposition of the two assets. One was a disposition, one was a retirement. Okay, so all of that gives us 19,000,005, and that gives us a net book value of 28,775. So altogether, that would be 50,062,500. So that would be what the property, plant, and equipment would be for this company. So first, land, there's no depreciation. There's no cumulative depreciation. For the building, we had to figure out the cumulative depreciation. The best way to do these, by the way, is using a T account. So if you don't want to make the adjustment on the statement itself, then perhaps do a T account analysis. And just capture all of the transactions that affect the cumulative depreciation for the building or the equipment. Okay? Thank you. That was long.